Good afternoon, fellow Rotarians. I'm Ruth Shelley, president of the Rotary Club of Portland. Welcome to our live weekly membership meeting, our first of 2021, and Happy New Year. I'm joining you from my brother's home in Wisconsin, where I'm visiting family. Wisconsin is an unusual place to visit in January, but it's a balmy 32 degrees and we're having a wonderful time. But I wouldn't miss Rotary, so here we are. Usually I have my banner with us, and as you remember, it says, Rotary opens opportunities to find solutions for today's challenges. Healing from the pandemic, recovery from the economic downturn, and peace building as we seek racial justice. This week, we start the new year on door number 2, focusing on recovery, as our speaker, Tim Dewey, talks about the fall and pandemic recovery to come. But first, let's welcome Rotarian John Love for our reflection. John?
Hi, everybody. One of my favorite Stoic philosophers is the Roman Emperor Marcus Aurelius, and a lot of what we know of his take on Stoicism comes from a book called Meditations, which he wrote during a period of strife in the Roman Empire. There's this really exceptional quote that has always stuck with me, and I think it's really relevant right now, both coming out of the year we just had and looking ahead to the year that we're beginning. He says, "Be like the rocky headland on which the waves constantly break. It stands firm, and around it, the seething waters are laid to rest. Don't say, it's my bad luck that this has happened to me. You should rather say, it's my good luck that although this has happened to me, I can bear it without pain, neither crushed by the present nor fearful of the future." And as we look back on the tumultuous year that we've concluded, and with our speakers today, look ahead to what the new year might bring, I think it's really important that we reflect on those seething waters that were 2021. As individuals, as a club, as a community, we were, and I think we remain, that rocky headland on which the waves will constantly break while we stand firm. And while I'm hoping we can start this year not merely with just a lack of fear of the future, but instead that we can start it with hope for what's actually going to come. So, thank you.
Thank you, John. What wonderful words to start our year. And please consider your own New Year's resolution to do a reflection for one of our meetings. We have 2021 openings available now, so please fill out the link provided in the chat box or email Siobhan directly. And now I'd ask that Rotarians who have invited a guest to raise their hand, and Maria will call on you to unmute and introduce them. Or if you're a visiting Rotarian who came on your own, please raise your hand and introduce yourself. Maria, do you see any guests today?
Well, I don't see anybody flailing their hands at me, but I do know that we have 2 guests that I have brought with us today. We have Phil, who is joining us from Portland. Phil, if you wanted to unmute yourself and say hello and introduce yourself.
Hi, my name is Phil Yen, and I do a couple of things. I work at a chemical company and I also co-own a coffee shop in Portland.
Wonderful. Up in North Portland off of Killingsworth. So if you guys want to know about some coffee shops. And we also have a guest today, Scott Jacobs. Scott, would you like to unmute yourself and introduce yourself?
Absolutely. I'm happy to be here. I'm a Portland resident as well. And I am the principal of Jacobs Strategic Group. And I focus my attention on elevating companies and people's careers through success and implementation of change.
Wonderful. Thank you, Scott. And we have Rotarian Steve Watts with a guest. Steve?
Well, my guest is Scott Jacobs. He just introduced himself, so we're good to go. Thanks.
Apologies for getting that in the wrong corner.
All right.
Wonderful. Thank you both. Welcome, Phil and Scott. We're so glad that you joined our meeting. And hard to believe, but it is January, and I'd like to extend a happy birthday to everyone with birthdays this month. We alternate each week honoring birthdays and Rotary anniversaries. Please note the names of these birthday people and reach out to one of them with a call or an email, especially since our traditional celebrations are limited right now. And as a daughter having a daughter who is born in January, and myself being born in December, I know that these holiday times are especially hard on birthday people, so take a note of these folks and reach out with your greetings. And now, please welcome Rotarian Scott Lofton to tell you about our Committee of the Month, Wheels of Power. Scott?
Hey, everyone. Thanks for the introduction, Ruth. I'm going to share my screen real quick, hopefully, and give you just a little bit of update on what's going on Wheels of Power. One of the things about doing this virtually is that I can share some wonderful pictures of some of our recipients of the mobility devices. So I'm going to do that hopefully here. Well, first I'm going to start with our mission statement. Just one of the things for any new members or people that just don't remember our guests is that our Wheels of Power committee is really focused around increasing the mobility of people in the Portland community. And Portland community is a little bit broad in our definition. It includes zip codes all the way from Gresham out to Beaverton and all the ones in Portland. But we really look for people that are looking to get out into the community, whether that is just to go to the doctor or to participate in some kind of charitable activity or go to church or just go grocery shopping, whatever they can do. And they're not able to do it on their own or afford any mobility device on their own. So we take in applications and we interview those applicants to see if they meet our qualifications. And generally we receive about 30 applications a year. In the last fiscal year, we actually donated 22 scooters and 3 wheelchairs and repaired 1 older model. This year it's been a little bit slower, and I think that really relates to the fact that it's harder for people to get into the seating clinics, potentially to be seen. They're mostly stuck at home. They're not able to, they're having deliveries. They're not having the ability to get out and about because of the pandemic. So our application rate is down this year. So if you do know of somebody or an entity that needs some help and assistance, or has members or people that are living in a community that need access to powered mobility, let me know and reach out to one of our committee members, and we'll see what we can do to get them in the applicant process. And one of the things about, like I said, about doing this virtually is I get to share some of the goodwill that we've received over the last, number of years. I've been the chair of this committee now. This is my 4th year. So I've collected some of the great goodwill and pictures of some of our recipients along the way, and just some of their kind words. The excitement they get when they have their chair and the ability for them to get out in the community is, borders on ecstatic some days. So there's a wonderful shared picture from Terry Gordon, who sent us a note. A few more members that received them. Some of these are recent. You see there, some of them are wearing masks. So this is from this last year, the last basically 12 months. People that are from all areas, all age groups, and really getting access to be able to get out of the community. So just sharing a few pictures. The last note as well, this is a more recent note from August of 2019, and I'm sure you can, if you can see the wording there, but really just a reflection of the goodwill that we deliver when somebody receives a chair and the kind word they send back to us, because they generally are so thankful for the work that we do. And it's the reason that I'm involved in that committee, in this committee. And, I can't go out and visit people to see them and interview them anymore, but talking to them on the phone and then receiving their pictures of when they get the chair has been fantastic during this time. So with that, I'm going to stop sharing, and you'll hear from other members of our committee along the way through the month, but thanks for the time to talk about that. And if you have any, I mentioned, anybody that may need access to some powered mobility, reach out to either the office or for sure any member of the committee. But if you can't find us, I'm sure that you can look up and find us in the directory or reach out. Thanks, everybody. Thanks, Ruth.
Thank you, Scott. What essential work. In fact, the brother that I'm visiting right now is in a power chair, and I know from firsthand experience What a change, what a transformation that piece of equipment made in his life. So please, if you're interested in serving on this committee, contact Scott. It is one of our most heartwarming committees in terms of the immediate impact of the donations that we're able to achieve. And to fund those donations of chairs, we rely on the Trust Drive. Please welcome President-elect Rotarian Reed Miller to give an update on our Trust Drive this year. Reed?
Hi, good afternoon, Rotarians. I'm excited to be here. I couldn't imagine better timing to give this update on the Trust Drive after following that Wheels of Power update. One incredible committee that we have here, one of many committees that our Trust Drive funds. So the update is we had a goal of 100% contribution and $189,000 to be contributed to the Trust Drive for this year. We currently have $115,000 pledged. We're off to a terrific start. So kudos to everybody. Thank you all very much for your generous contributions. We're doing a great job thus far. If you have not had the opportunity to make a generous donation, this is a great opportunity. The Trust Drive will run through the end of January, so we are running out of time. This is a good opportunity not to procrastinate. This is one of your few reminders for the entire Trust Drive, and we can get that off your to-do list. It just takes a couple of moments to go to rotarypdx.org. You can make your pledge there, or you can make a donation there. If you would like to send a wet check, you can send that to 1220 Southwest Morrison Street. That's Suite 425, Portland, Oregon, 97205. That is the location of our office. And again, I just want to remind everybody how rough of a year 2020 was for not just the Portland community, but all across the country. And this is a year that, you know, contributions are going a lot further. They're much more needed this year. And our objective this year for the Trust Drive was to not put pressure on people, because we do understand that it's been tough on a lot of business owners and a lot of our fellow Rotarians. And so we don't want to pressure people to do more than they're able to right now or put them in a hard spot. We understand if you're not able to donate as much as maybe you have in the past, but we do urge everybody, and we're looking for 100% contribution. And take a little bit of work off of my plate. I'm going to be making phone calls here shortly, so help me out and get those contributions in so I don't have to call every single person on here. But yeah, anything you can do is much appreciated. And you know, there's no end in sight in 2021. Who knows how long this lockdown is going to go? Business owners are in a bind, and our community members need our help more than ever. So I urge you, please, to check something off your to-do list today and make that pledge. Thank you so much.
Thank you, Reed. What a great New Year's resolution. And thank you all who have already donated to the Trust Drive to continue our essential service above self. Now we're all going to disappear and enter a virtual table talk. Please introduce yourselves to others in your group. A minute or so before you come back to this main meeting, you'll all get a visual heads up. And may I suggest a topic for your discussion? All of us are so happy to see the end of 2020. What are you happiest to leave behind in 2020? And what do you look forward to in 2021? Here we go. Everybody back? Not yet. I hope you had a good conversation. I know our table topic group was really animated. Okay. I hope we are ready to resume. Good enough. Welcome back, everybody. We'll start recording again in 5 seconds. 5, 4, 3, 2, 1. And now on to our program. After our speaker today is finished, if you'd like to ask Tim a question, Maria will moderate the Q&A through the chat box. Please welcome Rotarian Will Nolan as today's chair of the day. Will?
I will learn this at some point. I will learn this. So good afternoon, fellow Rotarians and guests. I'm happy you could join us. I'm also happy that Tim Dewey has agreed to visit us again. Maybe most of you probably remember that he spoke to us in early June, kind of just as the COVID shutdown was getting up in full force. And even at that time, he had a rather upbeat outlook on the economy, which was clearly out of step with the consensus. And since then, of course, the economy has rebounded, at least for stuff that we buy. Services, some of the services and the lower paying jobs that accompany them have not recovered yet, but hopefully Tim will bring us some good news on that front as well. For those of you who don't know, Tim is an economics professor at the University of Oregon, where he's been since, I think, about 2002. He also shows up from time to time on Bloomberg and writes a piece called Fed Watch, which I highly encourage anyone who wants to understand the Fed, what they're doing, what they're thinking, to subscribe to that. I'll put the link in the chat box after we're done with this. One of the best things about Tim is that he makes it understandable even for folks like me. So with that, I want to welcome Tim Dewey. Are you here, Tim?
I am here, and I am going to thank you for the introduction. And I'm going to go ahead and share my presentation. So just give me 1 second here. All right. Okay, so you should be able to see my presentation. Is that true? All right, great to hear that. So I'm not gonna actually do the share. I'm not going to start the presentation like a normal presentation because sometimes I've had problems with that. So if you can't see anything or you're having trouble with something, just please let me know and we'll have time for questions afterwards. I guess I only have about 20 minutes to speak, and I will try to move through this fairly quickly. But like I said, please make sure you have your questions ready. So I've been calling this the after the fall, the pandemic recovery, and thinking about what we're going to see going into next year. And I'll kind of apologize, my slides are mostly correct, but the data keeps changing so fast that they're not perfectly correct. So just keep that in mind, the general trends are all accurate here. Where do we begin? Well, I guess you mentioned I spoke with you in July or June. I can't remember all the conversations. And right then we were in the midst of really some of the worst of the downturn. We saw that in the second quarter of this year, output dropped by a pace that would put us shrinking the economy by about 1/3 if that pace had continued through the course of the year. And that would be a phenomenal rate of decline. And that phenomenal rate of decline really kind of reversed itself, or started to reverse itself in the third quarter, where suddenly we saw a really big rebound in economic activity in the third quarter. And really what we were looking at there was a couple things, one of which was just an end to the restrictions. I think the first round of restrictions we had were fairly indiscriminate. And because they were indiscriminate, they obviously shut down a lot more business activity than we think is probably necessary to contain the virus. And so it was actually, we're able to fairly easily able to bring some quite a bit of activity online fairly quickly. And so that's what we saw going on into the third quarter. And then that rebound really extended into the fourth quarter. And the question for us is, how do we manage sort of the near-term worsening of or softening of conditions, particularly with respect to those industries really affected by the resurgence of the COVID-19 pandemic in recent months, versus the longer run outlook now that we have a vaccine. And that's really what we're struggling with over the next couple months and over the next year. What I kind of have been trying to point out is that even though we've had some weakness in recent months, that it looks like output was still growing fairly quickly over the fourth quarter. This is a little outdated now. At the time that I did this slide, the expectation from the Atlanta Fed was that output was growing at about 11% rate in the third quarter. Right now, their expectation, or fourth quarter, their expectation is right now about a 9% growth rate, 8 or 9% growth rate, which is still twice above consensus expectations. And we kind of see this in a lot of data right now, where we know conditions were softening in the winter quarter, winter part of the winter, but we're still seeing fairly strong data along a lot of sectors. And that's what I really want to talk about today. And I kind of want to remind people that really what's going on in Oregon is really a microcosm of what we're seeing in the national economy. A lot of the same dynamics we're seeing play out. Oregon's economy is fairly diverse, and then means it will largely mimic, I think, what goes on in the national economy. And it turns out that the Oregon economy kind of tracks the cycle fairly well. There's this myth that the Oregon economy lags the cycle, and that's not true. I think maybe our ability to process the news cycle lags the cycle more so than the actual economy. So what's the sort of the bad parts that we're seeing right now? And I'm going to skip ahead here. Is that, we clearly experienced a sharp decline in employment. And we want to think about this a little bit, particularly when we look at it in contrast to some other charts. This is supposed to be sharp declines in employment, not unemployment. We've lost about 20 million jobs initially. We've gained about half those jobs back. So we're about 10 million jobs down. A lot of those jobs have been concentrated in service sector. So we know that sector has been the hardest hit, particularly leisure and hospitality, elective medical procedures, so dentistry, for example, anything like that people think they can put off that involves some kind of personal contact. That's obviously been the sectors that have been most impacted. Other sectors have been less impacted. It's also the case that the sectors most impacted were some of the lower wage sectors. So the interesting thing is that this downturn has had less of an impact on aggregate demand and spending than we might have expected. And I would argue that most of the impacts on spending are really due to what I think of as supply constraints. We'll talk about that more going forward. Supply constraints is just the inability of us to safely access some of these services that we typically demand. What's the story here? What are we thinking about? Sort of the good, the bad. We know that fiscal policy has really been unprecedented in this recovery, and has gotten a lot of credit for how the recovery has proceeded more than expected. This is current personal transfer payments. And you can see where I've circled here, this is the current sort of blast of fiscal stimulus. It is way outside the realms of anything we've seen in the past. If we look at the last recession, this is a very much smaller, oh no, okay, well, okay, luckily that's marked up because for some reason, my account just closed down on me. So that is actually quite unfortunate. Okay, let's see that. All right, there we go. Okay. It's a little bit of a technology challenge. So what's happening in the data? And I'm gonna sort of erase some of this stuff. There we go. Right. So if I kind of dive under the data and look what's going on underneath the surface of that fiscal stimulus, the blue line here is real personal income for the US economy. And you can see where that really jumped up. The black line here is real personal income excluding transfer payments. And what you see there is that basically that drop in income excluding transfer payments was basically the impact of people losing their jobs. And you can see the hole that essentially fiscal policy was trying to fill, right? Well, this hole here, right? This hole here, come on, it's not fighting me. Okay, that hole here was more than filled by this fiscal stimulus coming into the system. And I find this really interesting is that people I don't think appreciate just how much fiscal stimulus came in. And not only that, right, the fiscal stimulus really, in some sense, wasn't affecting spending as much as we think, right? So if I look at what happened to spending, spending collapsed during the early part of this crisis. Wages and salaries did not decline as much. And even today, the decline in spending has been more than the decline in wages and salaries. So even though wages and salaries went down somewhat, and actually they've largely recovered. Now you can see that almost wages and salaries have largely recovered since the downturn. Spending has declined more. And what's happening then as a result is this enormous amount of savings is being built up in the system. And I think this is something that we kind of have to start to think about and appreciate more than I think conventional wisdom has tended to focus on. What we've had is a supply side shock to the economy. And in order to address that supply side shock, we really threw way more resources into the economy than we've ever seen before. That did not translate into more spending. It really translated into a whole bunch of additional saving. And that saving is kind of like pent up demand that has to make its way out into the economy sometime in the future. And how it makes its way out in the economy, I think, is going to tell us a lot about what happens to economic activity in this next year. Right? And another kind of point along that way, right, is if I look at the blue line here is services spending, right? And we read it off of the left-hand side scale. And you can see the trend of services spending was like this going into the expansion, going into the recession. And services spending is currently right here, right? Way below that trend. When we looked at goods spending, this was the trend going into the recession, right? And now we're spending on goods more than we did going to more than trend, right? So what's happened is there's been, again, a massive shifting of spending within the economy, away from services and toward goods. And again, that's kind of another clue that this is more of a supply side shock than a demand side shock. If we look at the patterns of the last recession, they're completely opposite. People preferred to spend on services over goods. So goods spending dropped dramatically. This is the opposite situation. So again, I keep trying to think about this in terms of a supply side shock, a big supply side shock, rather than a demand side shock, because I think that really tells us about how quickly the economy can recover going into this next year. Right? So thinking about then this next year, what are kind of the reasons of optimism that I have for thinking about the future? Right? Well, one reason here is, I had changed my slides and there was some kind of problem here and it didn't change quite as much as I thought it did. One of the big reasons for optimism is, again, this wages and salary situation. Wages and salaries have recovered much more so in a V-shaped pattern than people, I think, understand. And so the blue line here is the wages and salaries during the 2007-2009 recession. And you can see that after the recession started, where the vertical line is here, right? Wages and salaries here tended to grow for about another year. The recession really didn't take hold until 2008, the last recession. And then once that wages and salaries dropped, it took a long time, right, for wages and salaries to recover, right? In this recession, wages and salaries have basically already recovered. Big V-shaped move in wages and salaries, right? Why is that? How did that happen when there's still 10 million people unemployed, right? Well, the problem or the situation is that I understand is frustrating is that, again, the 10 million people that are kind of unemployed are sort of shifted to the lower end of the income spectrum. And so they have had less of an impact really on aggregate activity than we might normally assume. This has been an issue that's frustrated us for the last 6 months. The initial budget forecast for Oregon economy, for example, expected a big revenue decline going forward. That big revenue decline hasn't happened. And why hasn't it happened? Because of Oregon's progressive tax system, because the lower income individuals who were disproportionately hurt in this downturn tended to basically tended to have very limited tax payments to start with. So this has been a real sort of inequity or an inequality problem that has been exacerbated by this downturn. And the only good news I can say on this is we've done some good fiscal stimulus to try to help support that end of the spectrum. And hopefully, if I'm right, a lot of those jobs can come back quickly in the next year after the vaccine becomes more widely distributed. So I think that's the silver lining here. The other silver lining here is that if I look at the JOLTS reports, right, which is the job openings, labor turnover reports, what we see are a lot of job openings. So if I look at what happened, this is the total openings rate, right? If I look at what happened in the last recession, job openings fell dramatically and stayed down, right? What I'm seeing here in this recession is that job openings fell and then bounced back up fairly quickly. That firms are still on average interested in hiring. And this has been a big shocker. Another place is the quits rate here, right? So this is the willingness of individuals to quit their job. And what we see is the quit rates fell in the last recession quite dramatically and then stayed low and took a long time to rebound. And this time it fell and then rebounded. And that tells me that people are willing to quit their jobs because they think there's another job around for them. And so I think that's important for understanding the outlook into this next year. Another thing that we should be optimistic about is that low rates are going to be supportive, low interest rates, easy monetary policy. The Federal Reserve is committed to basically a new framework which will hold interest rates near zero until inflation is actually at or above 2%. And currently, we're not seeing inflation really sustained above that level yet. We're having a little bounce back early on in the recovery from some weak inflation numbers earlier, but year over year inflation is only 1.5%. The Federal Reserve looks like they're likely to keep conditions fairly easy. Another reason for optimism is what I call the forced savings. There's over $1 trillion, I estimate over $1.5 trillion now. I've got November's numbers now too, of excess saving. This is saving above what people would have saved. The reason they have this excess saving is they can't spend as much as they used to because some of the goods or services they usually spend on aren't available, and also because of the massive fiscal stimulus. And so this, I think, is really a big factor. I think this is fairly hot money. This is total checkable deposits, and that's made another run upward. Basically, it's people money sitting in checking accounts. So I think that what's going to happen over the next year is that as the virus becomes less of an issue, that we'll see people go ahead and use up some of this pent-up spending. I think particularly in leisure and hospitality, and that gives me some hope again that segment of the job market that's really been most impacted can actually come back fairly quickly. Another reason for optimism here is the housing market's red hot. New home sales really surged in recent months. They dropped back a little bit on last week, but they're still very high. And you really have to go back to the last housing cycle, the bubble, in order to see housing starts at this level. And I kind of want to push this a little bit more and think about why that is. There's going to be a tendency here to think about housing just on the basis of low interest rates. The housing and the economy in general right now has a really massive demographic boom going on that I think is helpful. And so this is US population by age. And what I've been sort of pointing out here is that basically as you get into your 40s and into your 50s, as you get into your 40s, you're moving into peak earning years, right? Well, what's going on right now is these are the 40-year-olds, 40 to 45-year-olds, kind of a hole, like the bottom of the hole, the Gen Xers, the bottom of the hole in the economic distribution. Going forward, every year, basically the population of people moving into their peak earning years is getting bigger and bigger, right? The last time this happened was in the 1990s, right? And that was when this generation, right, the baby boomers, were just moving into their 40s and their peak earning years, right? So after the boomers, right, we kind of went into the demographic hole of the Gen Xers. We're coming out of that demographic hole over the next 10 years in the millennial generation, right? That's doing two things. First of all, it's moving that population through their peak earning years. And again, like I said, a bigger and bigger population. And secondly, that generation is also entering its home buying years, right? And so this is providing some fuel for the housing market. When I said this looks like the 1990s, right? That's what's going on, right? So if I overlay the 1994 population chart, right? If I overlay the 1994 population chart, you see, right, that same climb here going on, right? That same climb. This is the boomers coming in, and the blue lines is the millennials coming into the system. That same economic climb we went through the 1990s, right? That's going to support economic activity, I think, going on, not just this year, but going forward. Oregon has the same demographics, by the way, right? So Oregon's population by age is moving through the same pattern here, right? Get rid of that. Right here, right? So this is, I think, a positive for the economy over the next couple of years, right? So I think that's important. I'm going to go through a couple more things here before I run out of time. Financial conditions are very supportive, right? There it is, right? That equity prices are at record highs. Inflation expectations have been rebounding, so that's usually a positive signal. Bond spreads, longer term interest rates have been rising. That's generally considered a positive indicator if it's connected to an improving economic outlook. And oil prices haven't really taken off. So, and actually one other point too is that we could be moving into another cheap energy era with the development of widespread solar and wind power. And some people, there's been some really interesting stuff where people have been proposing that we shouldn't worry about storage for solar and wind. We really should be overbuilding the solar system, the solar electrical grid, because that's actually cheaper than developing storage solutions. So some interesting things are happening there. But we could be moving into the next era of cheap energy too, which I think would be supportive for the economy. And then finally, capital spending has been stronger than we might expect. Typically in a recession, capital spending drops dramatically and then stays low. So the last two expansions have had a long recovery in capital spending. Right? This V-shaped recovery. Basically, firms made up for their lost orders already. So I don't know that this climbs a huge amount going forward, but clearly we're back on track for capital spending. And this is a fairly unusual relative to other recessions. And again, I'm kind of trying to drive out that this is not our standard demand side recession. This is something very, very different. And because it's different, I think we have to have a real different view of what's going on going forward. I think there's a tendency to assume that this recession, there's always a tendency to fight the last battle, right? The last battle was the last long drawn out recession, slow expansion. I think that there's been a tendency to try to view and push, this dynamic into the context of the last recovery. I don't think there's a lot of reason to do that, right? The main problem right now for facing the economy is the pandemic. Nothing can get fully solved until the pandemic is really under control. That requires a massive vaccine rollout. We're just starting that process. I think we're fairly optimistic that over the next 6 months, we'll make some dramatic progress there. And once we get that dramatic progress done, I think you see some room for some really sharp improvements to the economy. There's a lot of pent-up activity that I think is still there. One sort of final note, there's some interesting other things. industrial production has not rebounded as quickly as we might think it would, given the recovery in a lot of these manufacturing numbers. Part of this, I think, is due to offshoring. We see the bigger trade deficit. Basically, if we give money to consumers and they can't spend it on services, they spend it on goods, a lot of consumer goods are made overseas, right? So it basically gets channeled out of consumers to retailers to overseas producers. So it's not until you get more capital goods spending, which we're now seeing, that I think industrial production starts to lift off. So that puts me at about 10 minutes left, and I'm sorry if that went too quickly, but I am ready to take some questions here.
Thank you so much, Tim. I'm going to help us move forward with our Q&A portion. So for those of you who didn't see it in the chat, as a reminder, our process is for you to raise your little electronic blue hand or shoot me a note in the chat that you have a question and I'll get you in the queue. We already have a couple lined up, so I'm going to get us started right away. And I'll start first with Rotarian John White. John? You're going to need to unmute yourself, John.
Good afternoon, and thanks for your presentation. One of my interpretations from it is that the stimulus missed its mark. The justification for the stimulus was to give money to people that were hurting. And my view of what you presented is the money went to people who could either afford to save it or spend it on big ticket items like houses, boats, cars, second homes, remodeling, and that sort of stuff. So, and that the people who are really hurting, which are primarily service workers, haven't been benefited by this. Is that a valid interpretation?
This is, this is a, this is a tension right now. And so particularly last spring, we threw a lot of money out of the system. Just to be, when you talk about making targeted actions, that can get messy really quick in the sense that, we don't want a bunch of people falling through the cracks, and we didn't know entirely what was going on. So we did push a lot of money out fairly quickly, and a lot of it was not targeted nearly as much as we would expect during a regular downturn. Now, I don't get too worked up about this at this point. A perfect system would have moved out money kind of much more in a much more targeted fashion. This tried to get at a lot of people during what was obviously a fairly difficult time. Now, what should we be doing going forward? We've done another set of rebate checks. There's a there's a proposal to increase the size of those rebate checks again. And there's again this tension in the political spectrum and the economic spectrum. Was that really a good policy? And here's what I'm going to say about that is that we don't entirely know, and this is kind of what I've been pushing on lately. What we've done is this massive experiment. We've never pushed this much money out that couldn't be spent. So we don't know really what the consequences are, good or bad. We know that those people that, were out of a job for, because of COVID and got extra money, extra $600 a week, they definitely benefited and were able to improve their lives as a result of that. I think that's that targeted aid you're talking about. As far as the untargeted aid, I honestly can't tell you how much is going to make its way into good spending, travel spending. Does it become inflationary? Does it boost asset prices? All of those things are possible. And I don't think policymakers have really truly appreciated how much of an experiment we're doing. I mean, I showed you the charts earlier. I might lose that. That's what happens when your iPad stops. Right, this, where are you? Right, this is the saving rate. Where's my transfer? The transfer payments, right? Current transfer payments, right? Transfer payments from the government, right? Moving up to nearly 35% of GDP, just is outside of anything we've ever done. So I'm really interested to talk to you next year, right? And think about, well, what did happen? Sorry, that was a long-winded explanation.
Next question comes from Rotarian Bill Diaz. Bill?
Thank you, and I want to thank John White for asking my first question, so I don't have to ask two questions. Thank you, John. My question has to do with you're outlining something that looks like a fairly strong economy despite the pandemic, the fact that we're coming back in many areas and many sectors. Is the stock market right now in a bubble? We keep hearing about concerns that it's overvalued, that the values of the equities are too high. Are we looking for a correction, or do we think we're going to continue the stock market growth into 2021?
You know, I'm fairly optimistic. What I think the stock market is telling us is that there's been a V-shaped or likely a V-shaped recovery or close to a V-shaped recovery. That I think is the central message. I do, however, can tell you a story where over the next year that evolves into something much more bubblish. And maybe you kind of see things like that happening. Maybe you saw Bitcoin run to 34,000 or something, right? That kind of sort of self-fulfilling mania, you know, being driven by some easy cash that's floating around in the economy could certainly, I think, evolve going forward as one of the consequences of dumping all of this money into the system. So that's something to watch out for. Now, you know, if you're an investor, I mean, this is an in and out sort of thing. I don't know how to tell you to manage that process. You know, there's various philosophies on that. You know, you don't have to believe the bubble to profit from it, right? So, but I do think I'm not worried about the rise in equities to date. I think you can push equities higher on the back of just the economic rebound. I think there probably will be some churning in the stock market that could sort of take some money away from last year's winners and redistribute them to the recovery stocks more. So you can certainly see that kind of activity going on. I'm not at this point worried about a general asset type bubble. Things like Bitcoin, I don't care that too much about. That's like people playing around, and that's not really driving economic activity. So you really are looking for, as problems, asset valuations that are kind of causing other impacts in the economy. And I'm not sure that we're really seeing that yet. But that's what I'd be looking for is really a sign of trouble is, you know, so thinking back to really, if you look back to the last decade in the housing bubble, right? Very different than the housing market we have today. If you look back to the tech bubble, you know, that's where some people have pointed out that some of the IPOs going on in tech look, you know, a little bit like they did then. So, you know, it's something I'm certainly keeping my eye on.
Thank you. Thank you very much.
Thank you, Tim. It looks like we only have time for one more question. So next in the queue is Rotarian Will Nolan. Will?
Thanks, Tim. Great, as usual. My question really quickly is, given the supply constraints that you mentioned earlier, and anecdotally, the empty shelves and the $5 2x4s I see at Home Depot, both of those would seem to me that inflation is inevitable and
yes,
coming soon. What's your thought on that?
So good question. And certainly one we're struggling with. It seems likely that if this forecast plays out as I expect, there's probably going to be a little bit of a rebound in pricing power. I would think particularly in leisure and hospitality areas, especially if they've been damaged by the recession, so there's not quite as many firms at the beginning. That should cause at least a temporary increase in inflation. Now, I think if you want to see if that becomes more of a self-perpetuating process, which is what I think you're really worried about, you should be looking at whether or not that kicks off some kind of a similar increase in wages, right? Because that's where you really get an inflationary dynamic going, is that if you get a higher prices, you get higher wages, and then the higher wages can feed into higher prices, that's where you really change the cycle. We haven't done that in the last 20 or 30 years. And so everybody has basically said that can't happen, right? So it's certainly on my radar, though, as something that can happen, right? for a couple of reasons. One is that people say it can't happen, right? Uniformly almost now. And so once everybody sort of says the same thing, it's time to maybe start finding a different story. Two is the Federal Reserve has really, I think, made efforts to look through any inflation, at least additional inflation. That means they're not going to tamp down anything really quickly. Three is, again, the potential for fiscal stimulus coming into the system and the past savings, past fiscal stimulus that'll move into the system. So all of this could be a real big slug of money coming to the economy that basically creates the right conditions at the right time. So I am watching. I don't think you should panic if there's some like increase in inflation, you know, as a result of some near-term supply constraints. I think you should be thinking instead of, does it look like there's a sustained increase in inflation and an sustained increase in wage growth that would feed into each other? That's what I think we're worried about. I'm not worried about just looking at as just because you get faster wage growth doesn't mean you get faster inflation, by the way. It could come out of faster productivity or corporate profit. So lots of different pieces there.
Thank you, Tim. All great questions, and I wish we had time for more. Next week, we'll hear from Dr. Keith Levitt on the blind spots in organizational ethics. This meeting will again be live via Zoom at noon on Tuesday. Unfortunately, I have an unavoidable conflict next week and will not be with you. However, our President-elect, Reed Miller, will be running the meeting, and I thank him in advance for his leadership. Today, I want to thank you and our virtual guests today, Phil, Scott, Bennett, and her husband. We're so glad you joined us. John, thank you for your reflection. And Scott, thank you for the insight into our Wheels of Power Committee. Reed, we appreciate your leadership of the Trust Drive, and thanks again to everyone who has already donated. Finally, Tim, thank you for your insights on the pandemic recovery, especially for giving us reasons for optimism. Seeing that today's attendance was twice that of normal, we know that your remarks were of great interest. So now, as we enter into a new Rotary week and a new calendar year, please join me in opening the doors of opportunity for healing, recovery, and peace building. As Rotarians, we're here to make our world healthier, more sustainable, and with justice for all. Thank you again. Happy New Year. And this meeting is adjourned. Bye-bye, everyone.